Good evening, everyone. This is Henry Gamble with SimplerOptions.com, and in today's free video I wanted to continue on with the theme that I've been sharing in some of these previous free videos on airlines. So the one I'm looking at today is through American Airlines. They are set to report earnings before Tuesday's open, so if you really want to play this through options, you've got to position yourself on Monday towards the close. Once the market opens tomorrow, you can trade shares of the underlying before the cash open, but you won't be able to trade options. So I like to get myself positioned prior to that report. This one's a little bit trickier because the pattern that I had talked about with Southwest Airlines and Delta and so many of these others were situations where you were kind of down in this zone prior to the earnings announcement, and that gives you a really great target to try and structure your extension with the expected move and take it up into those highs. But how do you look at this when you've got an underlying that has already made its extension? Well, there's a couple of things about American that have made me a little more bullish on this one, but here's a couple of ways that you can think about trading this. John has talked about some of the fundamental things that he's looking at in American that should push it higher, and when I think about trading this around that analysis, this is what I'd come up with. So I have three different trades, and I'm going to start with the most conservative and then move down into the most aggressive. What I look at it being the most conservative trade here is this call side butterfly. Now with this play, yes, it's going to take a little time because we'd already made that daily extension, but what I like thinking is if I've positioned myself around this $60 body, is that too far-fetched in relation to where it might move? If you come back down into the February series options, one of the great things about Thinkorswim is it will show you right here in the option chain itself what the expected move is. So is a $6 move out of line given the fact that we are trading 55.50 right now? Is this, the $6 move out of line into $60? No, it's essentially exactly where we'd need to be. So by paying $1.20 for the butterfly, that puts my break-even price at $56.20. Ideally, earnings can be a catalyst and kind of get us a little bit of pop to start moving with that one, but it's the most conservative because I have 25 days to manage it, and it was a very low debit. Now, continue on down with some of these other trades. This is a little bit more aggressive. This is the only trade that truly captures the implied volatility crush. These contracts have 4 days of life left, but you'll notice that I'm not selling a put spread. What I've done here, because in this situation the call debit spread actually gave me a little bit closer to a 1-to-1 risk reward ratio than selling the put credit spread. So that's why I opted for this trade. When you buy the 54 call, some things that you want to think about in relation to selling that 57 is just make sure that the 57 has some premium. A lot of times when people try to structure these call debit spreads, if they go too far out, just remember that kind of defeats the purpose because you're not really taking in any premium off the short contract. I felt like this was a happy medium, giving myself a decent break-even price and a decent risk-reward ratio to see if it can move higher for me. Once again, when I buy the 54 and I pay $1.50 for it, that gives me a break-even price of $55.50. We closed almost exactly at that price, so if we can move higher, that'd be wonderful. If we trade sideways, well then I get the IV crush, and if we trade down, then I define my risk by the number of contracts I take. Then, moving on to the most aggressive strategy, would just be a directional call. Notice that in this strategy, very, very rarely am I ever doing call options like this, but when I do set up something like that, I'm going deep in the money, so I'm not having to pay that extrinsic premium. I'm buying an option that truly has value, and then I can try and participate in that move over the course of the next 25 days. So, just a couple thoughts on various ways to play the airlines. If you are looking for more ways to focus on those consistent type trades and the one that I started with, this is a class that John will be doing tomorrow that I think will help with that. Now this is a completely free webinar. It's going to be Tuesday at 8 p.m. Eastern Time. You can take a look at the bullet points that he will be covering. Mainly it's just kind of moving over from this, like he talked about yesterday, the equity curve that can be all over the place versus taking steady, consistent gainers, kind of like that butterfly I spoke about. So, looks to be a great webinar. I always learn something from John anytime I listen to him, and I hope to see you guys there.